investors, welcome to our weekly market update. Today we will provide you the significant events on economic calendar. Let's get started. China's GDP growth rate for the first quarter of 2023 will be released. The government's target for 2023 is 5.5%, but the actual growth rate was 4.5%, which is below expectations. The government implemented a number of COVID lockdowns that disrupted economic activity, which contributed to the slowdown. However, the government has since eased some of the lockdowns and the GDP growth rate is expected to pick it up in second quarter. The impact of the China GDP annual growth rate on the market and the Chinese yuan is mixed. A weaker than expected GDP growth rate could weigh on investor sentiment and lead to all of Chinese assets. On the other hand, a weaker yuan could make Chinese export more competitive, which could support the economy on the short term. On Tuesday, US retail sales data for May will be released. Retail sales unexpectedly rose in May despite rising inflation. This is a sign that consumer spending remains resilient in the US, even as households are affecting higher prices for goods and services. The impact of the US retail sales on the market and US dollar is positive. Strong consumer spending is a sign of economic strength, which could support the stock market and the US dollar. On Wednesday, UK inflation data for May 2023 will be released. The inflation rate held steady at 8.7%, which is above market expectations. The high inflation rate is a major concern for the UK government, as it is putting a strain on household budgets and could lead to a slowdown in economic growth. The Bank of England is expected to raise interest rates again in July in an effort to combat inflation. The impact of the United Kingdom inflation rate on the GDP and the market is negative. High inflation is a drag on economic growth and could lead to a sell-off in UK assets. The GDP could also come under pressure as investors seek to move their assets to countries with lower inflation. Euro area inflation data for the June will be released. The inflation rate decreased to the 5.5%, which is down from 6.1% in the previous month and slightly below market expectations. The decline in the euro area inflation rate is a positive development as it suggests that inflation is starting to come under control. However, the rate is still high and the ECB is expected to continue raising interest rates in an effort and bring inflation down to the targets. The impact of the euro area inflation rate on the euro and the market is mixed. A lower inflation rate could support the euro and the stock market. On the other hand, the ECB tightening cycle could weigh on economic growth and lead to a sell-off in Eurozone assets. Thank you for joining us and we look forward to seeing you in the next update. See you soon.